Hello everyone. If you are new to the channel, welcome. Otherwise, welcome back. In this video, we are going to cover another aspect of the financial world, the exchange-traded fund, or ETF. I will try and go over various aspects relating to this topic. It will not be a complete guide, but by the end of the video, you hopefully will have a more rounded idea of what they are and how they operate. So, let's get into it. The exchange-traded fund is a financial vehicle in which investors purchase into the fund and by which an investment portfolio or asset manager uses the funds to purchase an underlying asset and manages the fund on their behalf. The fund generally has a defined strategy into which assets it will purchase, and this strategy is made available via a prospectus for investors to review before they buy into the fund. An ETF strategy can also include a weighting for each underlying asset as to how much of each the fund will hold. These assets can be things such as instruments, commodities, indexes, real estate, or derivatives. ETFs can be passive or actively managed. Passive ETFs generally invest in an index such as the S&P 500 or the FTSE 100 and spread the funds across them based on the fund's weighting contained in their prospectus. Actively managed funds target specific securities depending on market conditions and actively remove those which do not perform. Changes to the fund strategy will be made by the manager, who will inform all investors of the change and arrange for them to leave the fund should they not agree with the direction it is taking. Investors are entitled to a share of the fund's profits, should that be in the form of dividends from the fund's underlying assets or interest on cash held in the fund. ETFs generally come with a management fee from the provider. These fees can vary depending on the fund and the provider and can take the form of ongoing charges, transaction costs, or general account fees. Passive funds are generally cheaper for investors when it comes to these fees, as there are no management costs to pay for. ETFs are one of the main investment vehicles for pensions, as they allow the monthly deposits from individuals to be pooled and invested rather than managed for each individual, resulting in multiple orders for the same underlying. This allows for fewer transactions to be made, saving on transaction fees for the provider. This is one of the pros of ETFs. Another is a lower risk factor as investments are spread across many instruments across sectors. Risk is reduced in the event of a single or several stocks failing will have a lower impact on the fund as exposure is spread across multiple other instruments, making them ideal for long-term pension investments. Some of the largest ETF providers include BlackRock, the Vanguard Group, State Street Global Advisors, Invesco, and Charles Schwab. ETFs differ from mutual funds, also known as open-ended investment companies in the UK, in that they are traded on the exchange, as the name suggests. Mutual funds are purchased from the issuer directly, as ETFs are traded on the exchange and as such they can be shorted or brought on margin. As they are visible, the price of the fund is known to all investors, where mutual funds are agreed between issuer and investor directly, and only at the end of the day's trading. Some of the most notable ETFs currently doing the rounds on YouTube are the ones offered by Yieldmax. These ETFs focus on the largest US instruments such as Tesla, Apple, and Microsoft. They have gained prominence for their large distribution amounts, which are upwards of 60% per year, and have a monthly payout schedule. These ETFs are actively managed and aim to garner the highest amount of returns possible. Each fund operates on a strategy that they will buy and sell a combination of exchange-traded call and put option contracts. As these are synthetic covered call options, they do not hold the underlying asset to cover the options they write. This synthetic method is achieved by purchasing call options while simultaneously selling putty options to replicate the position. A traditional covered call option would require the issuer to hold the underlying asset. Otherwise, it would be a naked option. Income is generated in the funds by short-selling call option contracts. Additional cash is held in the form of short-term US Treasury notes. The exact method can be found in the online prospectus for the corresponding fund. If you are in the UK or the EU, however, you may not be able to purchase these ETFs. Due to the Packaged Retail Investment and Insurance Products legislation introduced in 2018, it prohibits investors from purchasing certain US ETFs unless they provide a key information document. This enables investors to compare the risks, rewards and costs of the different investment products. If, however, you have a portfolio of over £500,000, you may be considered what's known as a sophisticated investor, which will allow you an exception to this rule. However, many brokers still do not offer this even when you are a sophisticated investor. If you are lucky enough to get the opportunity to trade these funds, you will be hit with other barriers such as higher tax, transaction costs, and potential legal requirements. That is all for this video. Please rewatch if anything is unclear. Comment if you want more information, and I will make further videos. If you want more information on why I'm making these videos, please check this video here. As always, look after yourself and your money. And I will see you in the next video.